Greetings from FinStudy Club. My name is Ankur Kulshrestha, welcoming all viewers to a very important session on Overview of Passive Investments, which is part of the 26th reading of Financial Reporting and Analysis of the reading name Balance Sheet. Now, before getting on to the detailed of passive investments, it is very critical to understand the overall context in which these passive investments arise. Now, deliberately I have circled the first box here, which is to represent and distinguish it from the balance three boxes. Let's just understand what do we mean by intercorporate investments. In the simplest of terms, it basically means when one company invests his money into the other company. Now, we need to understand it in a manner that, let's say, here is the balance sheet of company 1, and these are the assets which are listed. Now, obviously, this will contain a lot of operational, or should I say, the core assets of the company. By core assets, I mean the assets which are in the own business. But sometimes what happens is that a particular company might believe that rather than investing into his own business, for different reasons, it is worthwhile to invest into some other one's equity or debt or any other financial instrument. So another important aspect here is that the investment can be in any instrument present in the capital structure, need not be only the equity one. So this is a very, very important aspect here, that the intercorporate investment can be any investment into the capital structure wherein one company has put in his money into the other company's capital structure. So asset of one will be the liability of the other. So if I were to make a balance sheet of company 2, on the liability side I would find some kind of an instrument in name of company 1. So that's in the simplest sense is an intercorporate investment. Like I said, there can be various meanings of these various objectives of such investment, which can be broadly classified into the active ones or the passive ones. By these, what I mean, the active reasons are those wherein the objective of the investor, which is C1 in my example, is to actively participate in the management of C2. In the simplest of sense, it means that basically C1 wants to manage the business of C2. That's called as an active investment, wherein you have cases second, third, and fourth. We are going to talk about all that, but let's just understand what is the passive investment. Now here, the passive investment is basically when the objective of the investor is just to earn some interest or dividend, which is not to manage the business of the investee in a very, very active manner. The idea is just to make some quick returns and make an exit. So your intercorporate, I had briefed earlier, can take four forms. One, it can give you no influence whatsoever, which basically means that your objective was never to gain any active involvement, and that is what is known as the passive investments. However, when C1 wants to control or in some way manage the business of C2, there can be three scenarios, which is by the investment C1 is able to get significant influence, which is generally the case with 20 to 50% of acquisition, or there is a complete control, which is generally the case with 50% plus, or that results into a shared control with C1 and C3, for example, are together controlling the entity called C2. So that's technically called as joint venture. Good news for the students right now for CFA L1 is that point number 2, 3 and 4 are part of the level 2 curriculum, so they need not bother about each of these. What is there in CFA level 1 is your passive investments, which we are going to talk now. So with that little bit of overdrop, let's come to the basics of passive investments, which is, to some extent have already been explained. which says that the objective of the investor is not to participate. So the keywords are not to participate, but just earn some quick return, make some capital gain, and then exit the investment. There is absolutely no influence over the investee whatsoever. However, like I said, that in absence of any information, we can assume that the ownership less than 20% is a passive investment. However, I would like to highlight a very important part here, the principle of substance over form. Now, this principle is basically the legality versus the truth. So this principle basically talks about that legally I might be controlling, let's say, only 10%. However, if even with this 10% I am able to get, let's say, significant influence, then I should not be classified under marketable security, which is the other name for passive investments. Or in other case, let's say, actually the ownership is 60%, but because of some reason, my control over the investee is not there. Perhaps because, the other company has gone into bankruptcy, or there is some other legal case proceedings because of which, there is some government intervention, making me, feel like an outsider. So therefore, even with 60%, the legality is 60%, but the truth is no control whatsoever. Therefore, I'm going to follow the substance over form. So, short point, we need to kind of look at this percentage in light of the substance of the transaction. Okay. Now, coming to the valuation part of it, which is going to be the meat of my sessions going forward, there are two broad options of valuation. One, and very important one, although very simple, is a fair value model, wherein the securities are valued at fair value every time I prepare a balance sheet, and the changes in the values are taken to the income statement. So let's say whatever is the value today, let's say T1 minus the value at T0. So whatever is the change, is taken to income statement. Short point is there is no OCI. The investor needs to make this choice upfront, which is something very, very critical. You can't really make a change every year. Although in level 2, we are going to talk about that there are circumstances where there is possibility of changing the categorization as well. The analyst should look at the footnotes to be able to understand, which categorization or model has been followed. The other model to be followed is, categorizing into 3 categories as per the intention of holding, which I have reserved this, not to be disclosed right now, to be discussed in detail later upon. So, with this little bit of overview, I'm sure that we're absolutely geared to look at the practice examples. In my next session, we are going to start with fair value model and then look at the 3 different categories on the basis of intention of holding. I hope the session was useful. We would love to have your feedback or any query should you have at the email ID finstudyclub@gmail.com. Thank you very much.